So as we turn to the U.S., we're going to look at what is happening with the consumer credit side, debt, and what does that mean for growth, or I guess the stagflation, again, that we've been talking about. But first, we want to look at what are people concerned about. And it's interesting when you look at the growing share of Americans see the economy, China, and Russia as major threats. I think it's important to look at cyber attacks from other countries is always kind of a continuous issue when you think about it. China's power and influence is becoming a concern, but that's actually flatlined just a bit in terms of where it is as more people are focused on what is happening with Russia and beyond. But the condition of the global economy is the interesting one, because the economy piece is also going to drive how aggressive other nations will get. Because if you think about war, haves versus have-nots, the condition of the global economy is going to really drive some of the other pieces. Climate change has fallen down a bit. Obviously, the spread of infectious disease has gotten better, given the, I don't want to say the end of COVID, but the less deadly or problematic piece of or mutated COVID version that is out there is going. But the global economy is, I think, one that is going to take more and more space in people's minds. And as they get more concerned on the global economy, they're going to be less likely to spend. So for an example, if a consumer is concerned about Russia's power and influence, is that going to stop you from going to McDonald's? Is that going to stop you from buying a T-shirt or a computer? No, it's not. But your concern on the global economy and should I have some extra money squirreled away? Is there a chance I'm going to lose my job? Those concerns is where you're actually going to see a real shift in consumption patterns and therefore in the underlying economic growth of the country and obviously the globe, with the U.S. being the largest consumer in the world. And that's when you start looking at borrowing. So when you look at April retail sales, they held up well, but credit card spending growth of 19.6% continues to outpace that of car and student loans of 7.1% in April. So total credit increased $38.1 billion from the prior month after downwardly revised $47.3 billion in March. Now the estimate was for 35. So when you look at it, it's like, yes, retail sales did hold up fairly well, but the U.S. consumer spent a ton of money on credit in order to maintain some of that lifestyle. And I think this chart does a good job of putting it into perspective. So zooming out, going back to the 1960s, you see that steady move up in credit, in credit card or consumer credit outstanding, and then you can see the drop off following the 2006 crisis. I should say 2007, 2008 crisis, but then we gradually went back up, but it took time to take out that high that we had post the great financial crisis. But look how quickly we took out what people paid off. And then this daily shot zooms in on just from 2016 to today. You can see that during that 2020 period, a huge amount of credit was paid off. People were living, they weren't going out as much. They had more government transfers coming in. They were able to spend down, but now we're back above pre-pandemic levels. We have set a new all-time record going back to obviously the 1960s on revolving credit. Now, again, how long can people maintain this when you look at the fact that the discretionary income is shrinking? It's negative. Wages aren't keeping pace with inflation. And again, that spending is coming into pressure. Net non-revolving consumer credit is now back above and has accelerated. And this is, again, when you think about equity lines, mortgages, you can see that there has been a new resurgence of this activity. But as these pieces continue to roll out, the question on unit labor cost comes back into play. Because this is the unit labor cost for essentially one metric of production. And you can see that we've had spikes here before. So a spike isn't the problem. It's when you hang in at this elevated level, something similar to that we had in the 70s. We started to have that in the let's call it 2011 through 2012. But look at how in this period of time, you're getting a lot of this convergence in elevated levels. This is what would lead to that wage spiral. And the wage spiral is simple in the sense where living costs go up, so people raise wages. As you raise wages, you have to raise prices to cover the increase in wages. So then that pushes up again the cost of living. So then you have to give another living cost adjustment. And again, you can see how that continues to walk itself up. And this is what we look at when we're talking about, well, is this a possibility? And it's not saying that it's a definite, but this is saying that this is a real possibility and not something to be ignored or pushed to the side, but realistically front and center when we're looking at what are some of the things that could happen going forward. And that's when you start looking at that global industrial recession risk. The breadth of expanding developed markets continues to pull down, and this is looking at new orders versus inventories, because new orders have slowed, inventories have increased, which again is going to continue to pull down and ratchet down on the global economy with, again, that bigger impact on the US, because as people see this, they will look to spend less. And that's when you start looking at the growth tax. And the growth tax can be considered, just based on dollar, oil price, interest rates, just essentially inflation. Inflation, if you're assuming that as a growth tax, where is that going to pull us? And you can see that as the growth tax and inflation has increased, that it's going to bring a downward pressure into manufacturing. And then when you look at what does that do to real household disposable income, you get an idea on how it takes away a lot of that buying power. So back to the first period, when we looked at the how 1/4 of U.S. Americans essentially can't, they really can't. They're running light. They don't have a lot of activity. They don't have a lot of earnings. So losing this real disposable income is going to hit them even harder, pushing them again back into and more into the credit side. But when we start looking at different functions, you can see that the probability of U.S. recession based on the 2 and 10 yield curve is the highest it's since February of 2007, which essentially this is indicating and flashing a warning signal that there is a likely slowdown ahead. But then when you start looking at the actual pricing of it, when you look at there are few signs of recession in market pricing. So some of the indicators are showing risk. But then when you look at what the actual pricing is in both the equity and debt market, you can see that people are still, I don't want to say lackadaisical, but ignoring some of the underlying signs that continue to be pervasive in the market. With this just being another, with the U.S. CEO confidence shifting lower, again, that's going to just pull down because they're seeing corporate profits. They're getting more concerned on profits, but it also means that they're going to spend less on CapEx, and you'll see that move a bit lower. Then when you look at trade balance of goods and services, the U.S. trade deficit eased sharply in April to $87.1 billion versus $89.5 billion, which is what we were saying, whereas imports slowed due to lockdowns in China, exports were going to stay fairly good. So because they stayed fairly strong, that was going to, again, where exports would bounce, imports would drop, and this puts into perspective where exports continued to go up, imports slowed down, which again provided that positive bump, which will be a net positive when we look at the GDP side. Still negative, obviously, because we are a net importing nation, but that's where it's a bigger shift. All the while, zombies continue to rise, so the count of zombie firms remains significantly higher than pre-COVID. And as that's the case, as rates go up, it's going to because a zombie corp is someone that needs debt because their cash burn is higher than cash flow. So because of that, again, more stress, more problems, more issues coming through. And that's when you start looking at the high yield bond sales tumbled as creditors balk at riskier borrowers. So then as they look to roll debt, both two pieces, roll debt as well as issue new debt, you're going to find it harder and harder to find buyers of that debt. So then when you look at the inflation side and how pervasive it is, this just gives you an idea on how there's over 5%, what is increasing at over 5%. And you get an idea that there is almost 70% of goods in the market are increasing month over month at over 5%. So as the inflation expectations go up, you can clearly see where the Fed funds rate should be and what the trajectory is going to be and why we continue to see that stress. So if you think about people and consumers borrowing on credit, well, your credit card, the interest you're paid, your charge is going to go up as well as that Fed funds rate goes up. As that moves, then again, the cost of that credit is going to increase, which is going to incentivize people to not borrow as much on credit cards, which again is going to result in that bigger slowdown. And then it's also going to hit the U.S. government, because when you think about long-term data projections, the interest of rolling that debt, because not only is the U.S. government rolling debt, they're also issuing new debt because we're spending above our tax receipts. So that just means that the underlying cost is going to go up, and we should see our interest expense being almost over 3% of GDP in order to cover some of the that outlay. Then when you look at some of the recent indicators, ISM services PMI fell in May 50 to 55.9 versus the estimate of 56.5. Headline now at the lowest since February 2021. New orders moved up, which is a positive. Prices paid eased a bit, still very elevated, but eased, so that's a positive. And supplier deliveries ticked down, which should continue as things normalize a bit. But business activity also moved lower. So employment popped back into expansionary territory. But again, we've talked about how employment's going to be fairly flat, slightly negative, slightly positive, but it really holding still as we see a broader slowdown in just the underlying numbers. And then when you start looking at manufacturing side, so first services, now manufacturing, April factory orders came in at 0.3% versus the estimate of 0.7%. Slowdown still expanding, but again, slowing. And despite this softer monthly print, orders rose 14% versus 12.9% in the prior, which is a positive leading indicator on the manufacturing side, which is why we've been saying we expect growth in Q2. Q2 is going to be a quarter of growth versus last quarter, which was negative. But it's just we're going to eke out growth because there's an equal amount of headwinds and tailwinds, but we still think the tailwinds have enough to win out in this section, in this quarter. Now, wage growth has decelerated overall, but there is still substantial variation by industry. And it's important to look at the last 12 months, the last 3 months, how there has been an increase, but look at the average overall. So when you look at some of these pieces over the last 12 months, which are up 5.6%, 3%, 4%, you're still not above inflation. So even though your wage is going up, but it's now decelerating, inflation is grinding higher. So the wage dispersion is getting worse when you think about real earning power and real discretionary income. So so this is where we start to see some of those problems, and this just puts it into perspective where wage growth remains elevated, but is likely already peaked. So as it peaks and now falls with inflation, now even though the rate of change of inflation is slowing but still growing, you have wages falling, inflation still going up, which again is just making that situation worse for the consumer and underlying spending. And some of that wage pressure is going to continue as a bit more participation comes back. It's still below pre-pandemic, but as more people re-enter the workforce, again, that's going to bring wages down because the employer is going to have more choice. Now, if we look at U.S. labor force participation rates, this is obviously getting better, but it's the matter of how quickly do we see this recover. And then when you look at U.S. average hourly earnings, all employees, you can see how it has started to go negative, down. But again, we think that it's gonna go a bit sideways. We don't see it going to 6%. We see it bouncing between, let's call it 5% and 5.5%, because as some of the supply chain gets a bit better, that's going to free up companies to throw a bit more money into the wage front because they already raised pricing. So as costs come back from the supply chain, that'll help them fund some of the wage front. But the issue is going to be, what does that mean going forward, where if inflation continues to go up, again, it's shrinking the spending capacity of people. So that's what we have for you on this. Now, in the next segment, we're going to go a bit deeper into what comes next for the consumer in terms of where are they going, what is housing doing, how are they feeling, and what are some of those leading indicators in terms of the pressure and why we think Q3 is going to be a bigger problem than Q2.